I see some green shoots.
We need to have some kind of stupid bar.
I just think this is a classic structure, Lamont.
And I'll show you guys, a little trick here.
When you see some of the stuff that we're working on, you're going to like it.
Welcome back to the Wyckoff Nation, to the Wyckoff market discussion. Today is June 28th. This is session number 26 of year 2023, episode 357. Yes, this is a weekly episode 357. For those of you who are guests today, we've been at it for years and years together with Bruce. So today you kind of have the preview of what we do on the weekly basis. Let's go through the curriculum really quickly. On Mondays, together with Alicia for the Wyckoff trading course, that is coming to an end. But you could most definitely, sign up for the on-demand version of the WTC1. And then on Tuesdays, WTC2, we're finishing the semester as well next week. So with that, for those of you who have attended WTC1, you are eligible to go to the next level, WTC2. The registration is open, so you're welcome to register. Wyckoff Tape Reading Lab, together with William, is on the summer schedule and on Wednesdays at 9 a.m. We release the Wyckoff Bias game to our practicum students on Tuesdays. It comes out on Twitter on Wednesday as an assignment, and then on Friday as a solution. So check that out at Wyckoff Analysis on Twitter. On Wednesdays here live together with Bruce for the market discussion, and then on demand with Alessio for crypto discussion. On Friday, Johnny Scan releases his market report, and Bruce posts either the power charting blog on stockcharts.com or power charting video episode on Stockcharts TV. And over the weekend, look at our communal Wyckoff watchlist for your selection purposes, and also watch the episode of the Anatomy of the Trade together with Franz and John. I want to point your attention right away to one thing right here, and that is the WMD promotion that we have in today. So from $99, we are going down to $79 if you're going to sign up in the next 7 days before the next session, before next Wednesday. So as you watch us and you're saying like, yeah, this is good stuff, I want to be a part of this community on a weekly basis, here's your opportunity to get that promotional rate. For those of you who are current students at $99 per month rate, you will be automatically shifted, to $79. So do not even worry about this. You don't have to do anything. We'll do this for you. All right, and then one more announcement, and we're going to have different announcements throughout this session. Best of Wyckoff 2023 in San Francisco at Golden Gate University. If you have an opportunity to join us for July 13th, and I don't see the dates here, right? So July 13th, 14th. This is going to be a very interesting event. Look at day one, day two. Day one is all about workshops. We're going to have an intraday workshop. We're going to have a swing workshop with William and Bruce. Those are going to be very exciting because those are going to be action sequences based workshops, meaning that you will have to work. A workshop is from the word work, to work. So you're going to have 16 puzzles to solve with our feedback and with your post analysis. This is an extremely valuable event. And for those of you who can't attend it live, consider just buying the recording for day one or for both of the days. And we will send you also with the recordings all of the slides, whether those are assignment slides for action sequence or the solution slides. You will be able to do this at home. And there is such an immense value for that. So I'm looking forward to that. Then day two, we've got quite a lot of interesting events. Obviously, like a Q&A panel. And then look at this speed reading charting. So we're gonna go 50 charts in 50 minutes, 50-50. Then we're gonna premiere our documentary about Hank Pruden. So this is the first TV project for Wyckoff Analytics. I'm extremely proud of our team, to go in this direction and creating this piece. And then we're going to have Wyckoff Walkabout, where all of the 6 instructors are going to talk about their themes. We're going to talk about the process. We're going to talk about PNF, cryptos, intraday, Wyckoff contextual scanning, and anything else that is of interest to you during those sessions. So pretty packed conference, and there is a lot here to learn and to practice. So we are welcoming you to the conference. If you can't make it, just buy the recordings. And with this, let's go to our market charts. This is the regular way of how we're doing this. Bruce, how are you doing today?
Terrific. Great to be here, and hi to all our guests.
Absolutely. You sound great. So let's just dive in right into the market analysis. This is the chart of the S&P 500, E-minis, futures. And I guess the biggest question, Bruce, that we've been addressing in the last week or so, as our students are asking us about this reaction, this most recent reaction. Is it a bullish reaction or is it a bearish reaction? Meaning that, is this a reaction in the context of an uptrend? And is this an okay reaction, or is this something more? And I've been catching a lot of sentiment from students or from the social media people, and people are still divided. Some people are still thinking that we are not necessarily in the uptrend, that we're in some kind of upthrust in action. And we're going to show you that scenario later on, so stick around, just to get to that point. But how do you view this reaction in the context of everything that has been happening since September, October lows?
Well, there's been a beautiful acceleration after the backing up type action that we had into the end of May, and then really a great jump and acceleration on expanding volume. Now there's a bit of a climactic quality that we've just seen here into these, right, with volume, and it's not to be unexpected that we would have some kind of a climax that would come at the conclusion of it, even a short-term move. And we have seasonality. We'll look at it. We are at the end of the quarter. We'll talk more about that in a little bit, but being at the end of the quarter is a very important period in the markets. We talk about it all the time. And there is still seasonality that suggests that we could move higher from here, and point and figure counts too. So I don't see anything here that's really out of the ordinary in regard to the way that the market is pulled back and the volume is dried up. And so we'll just have to see whether or not we can get either a retest of the near-term climactic highs, or we could go up and retest and continue for a while. So I believe that's entirely possible at this point in time. And also we have point figure counts that would suggest that's definitely a possibility.
Mm-hmm. Well, let's finish this thought first. I mean, if you're in doubt where we are in the structure of the uptrend, you always have, and you're thinking like, oh, it's going to go down. You have to think about how that change is going to happen. So I'm going to extend a little bit on what Bruce has just said. And we would look at the change in 2 ways. We would look at the character change. And the character is usually going to be associated with what? With the volume, with supply. What is the volume doing here? The volume has decreased. Supply has decreased. Selling has decreased. We also would look at the selling through the prism of the price action. So we're going to look at the spread extension. We're going to look at the distance of the swing. And when we look at the downward spread on this reaction, it's actually also decreasing relative to what? Relative to places like this, like this, like this. So it shows us that the selling is there, but it's not intense, it's not aggressive, it's not distributional quality. Then the second thing that you need to think about when the change happens is the actual result. As changes happen, usually the result of the change is going to be a break of the structure. So what kind of structure would we be breaking here? I would say that these two important resistance points that create the resistance cluster, and specifically this bar that happened on the gap, this was actually over the weekend, I believe. So discounting of that happened like, in that way. I actually, yeah, something associated maybe with Tesla or something else. But this is the area where you have to go through and break through in order for us to say that the change of behavior has happened. Has this happened? No, obviously not. So if indeed this would happen, and we'll show you the scenario under which it might happen, then we would have to start thinking about more bearish thoughts. But so far it's an uptrend. And Bruce, you have mentioned that we still have some higher targets, some PNF targets, some horizontal PNF targets, for this formation. So what are we looking at here?
So what we see there, this is just a simple swing trading count structure, and there's the September, October lows, and that count put us right into the area that we had very formidable resistance at around the 4150 level on the S&P. And that resistance area continued to have influence all the way into the May period and then the breakout. And so the fact that we spent so much time here means that we were basically absorbing overhead supply, significant amounts of it, and that it took a long, long time to do this. And we built a second swing trading count. And arguably, there's a much bigger count that's out here and available to us, but let's just focus for the time being on this near-term count, which goes 4,500, 4,750. And so far, we've gone up to, we hit a high reading here. Let's see, the high was 44.48. So we've continued to be, we're still in the 4,400 box. 44.48 was the intraday high. And so we still have potential movement, minimum 4,500, 4,750 on this swing trading count. Don't have to fulfill it, but we typically do at least fulfill the minimum objective. And if this is really a bullish breakout, I suspect that we're going to go up very near to that area, get into that area, and then have a more important pause or reaction. And so, and we still have positive seasonality into the middle part of July.
All right. By the way, for those of you who are interested in the point and figure, we just completed with Bruce this course. This is the collection of all of the material that we have done in the last about 10 years. And we've done quite a few sessions on the PNF. So now what we've done is we call this a complete PNF course, meaning that sequentially, the outline starts from the basics and the reasons of why we're using the PNF, and then it goes into much more complicated material of the intermediate advanced level. We discuss here different things like, for instance, swing counts, intraday counts, timing with PNF, tape reading with PNF, percentage scaling. There are quite a few case studies here, and this is, I mean, by far our most favorite on-demand product, from students. So please check this out. Bruce, you have mentioned seasonality. Why don't we go there right away?
Mm-hmm. So this is an example. We look at this often, we update it. What I do is I lay over, in this case, the NASDAQ 100 over the seasonality, because it's been really a very good model to work with, and it worked really, really well in 22. So what we're doing is we're looking at only the pre-election years, the year before a presidential election, seasonality, and we've gone back the entire database, 73 years. So every 4 years, the year before a presidential election. And so you see, what we look at really with seasonality is directionality and then we look for whether or not there's a family resemblance here. And you can see with a little bit of a lead, the market has been doing a wonderful job of working higher with, this is the NASDAQ, with the positive seasonality that has been in place all the way through the year. We see that this seasonality peaks out sometime in July. And so we always say, look for important peaks and troughs at the ends of quarters, plus or minus 2 weeks of the end of the quarter. And I've studied these quarter end effects going back into the 1800s. And they're very real. The markets are very much dominated by institutions. Institutions are definitely driven by the calendar quarter and the calendar year. And so they make decisions, unfortunately, at the end of quarters. It's commonly referred to as window dressing. So it wouldn't surprise me if there isn't a continuation of the upward trend. And we see here that the character of the second quarter of the year has been to go up. And so really since the end of March, the market has had an upward bias to it, and it is likely to follow through into the end of June, which is Friday, and into the new quarter. Then you can see that in the third quarter, we have more of a sideways trading range, and I have more on that here in a little bit, because I think that what we may see is rotation. This may be a rotational effect. And so there could very well be great things to do, but being really attuned to the rotation could be very, very important. And we'll talk about that when we talk about the Big 8. So with that, Ramon, that's the NASDAQ 100. And you can see that there's definitely a family resemblance here between what the NASDAQ 100 index has done, which is dominated by the Big 8, and also seasonality.
Bruce, and I was looking into this area and comparing it to this rally in NASDAQ. And I might say, like, okay, well, what if this low corresponds to this low right here? So maybe we're just, going a little bit faster this time.
Yeah, absolutely.
Then we have all of these lows right here, this high. And again, the market is in such a bullish mode right now. All of the things that we were looking and we were talking about since September, October, and we were saying we are in a bullish environment. First, be selective, be among the leading big cap stocks, because they were leading all the way through. The concern was about the breadth. Then we saw the breadth expand, and that went away. Then what about we're still in the trading range formation? We broke out. Now it's the reaction. Even if we are gonna react, let's say like this is a temporary stop in action. We could be here for some time and we could go into this trading range, but the overall trend is still up. It's until those changes in character and also in structure that we'll start observing need to happen in order for us to say that something has happened, something is not going right. If you are thinking more about like bearish scenarios, I would go to the weaker indices, and one of them is Russell, Bruce. And to me, again, just looking at what has happened, what has transpired most recently, and we've talked about this, but also I will be very, very brief and quick. First of all, the banking crisis creates a very formidable presence of buying at the stop in action, at the local stop in action. This is also a very important point here. It's a higher low relative to September and June lows. And from here, we see a lot of attempts to follow through to the downside, and all of them are failing with the demand tails. Another attempt to fail, another attempt also fails. And as we start going up, we see the increase of demand signature, and we see how the local resistance, where we had some trouble overcoming this, capitulation on the banking crisis event, it actually energetically is being negated. And behind that, there is a momentum. So the two most important bars is this and this. And this is the most important resistance. And look what the price does. The price comes exactly to this point, shows a hidden presence of the demand, and then reverses and start going up. And the key was just to overcome this last capitulation bar. And today we've committed above that. So it's definitely a bullish picture. There is no, very much hidden supply that drives the prices down, that changes the behavior. Not yet. We are still pretty much, following a very logic of Wyckoff, where we see in the stopping action, the testing, then the change of behavior, then the test of that change of behavior. Russell is weaker, so it's still in the trading range, but it's definitely, Bruce, looking bullish to me at this point.
Let me posit a theory here. It seems like a good time to do this because the Russell's really important to this. I believe that what is happening, it's already happening. Huge amount of appreciation in the Big Eight. All these institutions, I don't care what area of the market they're in, they're all wedded for performance reasons to these Big Eight stocks. And they own them in a market capitalization way. They are way, way overweighted in these companies, and they've appreciated substantially. Now, these stocks are now a much bigger proportion of their portfolios. They are going to, I believe, start to pare back as they come into the end of the quarter. They're going to hold these stocks into the end of the quarter because they want to be able to show them they're never going to sell them. They're wedded to these stocks. But they are, I think, for portfolio management reasons, going to reduce their exposure somewhat. They are going to raise some cash away from these Big Eight, not appreciably, because they still have to own them in a market cap weighting, but they're above a market cap weighting because of the appreciation. So what they're going to do is they're going to rotate those funds not out of the market. They're going to rotate them to more value-oriented areas of the market. And we're already seeing that in the industrial sector, in the material sector. We're seeing it in the value-oriented stocks that are in the Russell. And so I think that what we're seeing is a rotation that is just a migration of cash away from the over-owned mega cap stocks towards the under-owned industrial companies, companies that benefit from the real economy, transportation stocks, and so on. And those stocks are catching a bid right now. And I think it's just rotation. It's not going to appreciably drive down these mega cap names because they own them in such huge proportions. They sell a little bit. It's going to engulf these other areas of the market in liquidity.
Yeah.
And I believe that's exactly what's happening here, and it will happen in the third quarter.
Yeah, Bruce, and we've talked about this many, many times. Again, the market is all about money going into one theme, then coming out of that theme and going into another theme, and that's rotation. And when we look at the charts of one-year charts of the Big Eight,
yeah,
I mean, I don't see any structural changes.
no.
Like where's the change here? No change.
They would come in the third quarter. They're not going to sell any stock until they're not going to sell appreciably much stock until they get into the next quarter.
Yeah, and it seems like, oh my gosh, we have traveled so much. Let's say Meta, Facebook, from below 100, to almost 300. That's a big move. But don't forget the background of what has happened into this low. Don't forget that 2022 drives those stocks into the extreme oversold condition. Don't forget that the Big Eight were not necessarily the stocks that were leading us out of the bear market. It took some time for them to find that rotation into them in 2023.
Yeah, they really didn't catch a bid until we got into the end of December, and finally that's when the important low was put in these indexes that stocks are dominant.
So the big message here, again, I'm going to repeat, Bruce, here, profit taking in the big eight to be expected soon, where the money is going to go. It's going to rotate, where it's going to rotate, small, mid caps, and specifically industrials, materials, and discretionary.
Yes.
And we're going to go through this, Bruce, the sector.
It'll happen in the third quarter. And let me just make this point again. These institutions across the board are going to continue to massively overown these big eight, these super mega cap stocks. They're just going to take some of their appreciated profits off the table from the first and second quarters of the year.
Yeah, and they can't really close those positions because how do you close the positions of outperforming stocks?
Yeah, and they're not going to underweight them. They're going to be overweighted. They're going to continue to be very large parts of their portfolios because that's where they perceive their performance is. So,
Bruce, you mentioned 3 areas where the money might be going. And I think that we're already seeing the evidence in those areas of outperformance, or at least the beginning of the outperformance. You mentioned industrials, materials, and I want to add discretionary to this list.
yes.
Could you talk to us about these 3 sectors?
Well, look at the relative strength lines that are underneath them, and relative strength is very important to us, and it was very important to Richard D. Wyckoff. You see that the relative strength line is in a northward direction, and it started to happen in the case of the industrials, really showed up in June, where they went from underperformance to starting to outperform. And look at the outsized rallies in these industrials. I think that that is a evidence of migration, and also that the economy is not as weak yet as people say it is. And so the industrials are catching a bid. Also, there's deep value in those stocks and dividend yield. So in the case of the materials, you can see also the materials relative strength. It's attempting to build a base here. And the rally that we've had in the month of June has been robust. It's up against resistance now, but it's in a northward direction. And then, of course, you can see discretionary, which is spending on really big ticket items, washing machines, refrigerators, automobiles, and things like that, is really not making relative strength new high, and is broken out and taken out the February highs from early in the year. So, and look at that reaccumulation structure in the discretionary that goes back. That's a huge cause, which we would look at from a point figure perspective. Also, communication services, look at that incredible leadership there. And then, of course, technology has just been absolutely leadership. I love to see technology going up because technology really does incite the public, the market speculators to come back into the market and start to trade and become active again. And I think that that's what technology's done here in the second quarter.
Okay. All right, let's move on. Let's talk about something else. So we've talked about the P&F. This is the causality. This is how much fuel is in the tank for the price to still to go up. Here's the analog. We usually go and discuss a lot of analogs from the past. This is one of the analogs that we've been using for since the beginning of the year, maybe a little bit since maybe like the end of the first quarter, but we've been using it for a while. And it's been actually proven pretty valuable to us. So at the top, we have the gold futures, 2020, 2022. At the bottom, S&P 500, 22, 23. And look at the resemblance of the structure, of the structures. I'm not going to go through this item by item. You should be able to see this with your own eye, how those points correspond. And this is where we are right now. So we are breaking out above point number 16 into a sign of strength that is attacking what? Attacking point number 8, which was the August high for the S&P. And with that, between 18 and 19, there is a very interesting reaction here. This is very fast, but it's there. So currently we are exactly right here, and we exactly, Bruce, right here at point number 18, trying to actually recover and go up. And to me, Bruce, this analog still is working, and I would be thinking that if the price breaks this high right here, we're gonna have, if this was the institutional fear of missing out trade, then as I say, we stated before, the next leg is going to be general, institutional, and retail public coming into this, because for those market participants that were in cash and the market has advanced significantly. I mean, like you look at the tech stocks, NASDAQ, if we're going to touch the all-time high, we're going to be at 50-60% for the year in tech. This is very extraordinary. So you can imagine how sentiment is going to shift, and everybody would want to be in the market, and that's going to produce the next leg of this fear of missing out trade. In fact, we've been talking about the fear of missing out trade for quite some time, again, using this analog. Bruce, what could you add to this? Is there anything that you would say like, oh, yes, it's still working, or maybe no, maybe there is something that is not working in this case?
Well, I think back to what we were just talking about. We were talking about the potential for more positive seasonality as we get into the new quarter for some period of time. And we can see that that would rhyme with what we're seeing here with this analog, and also a more climactic surge. And you would expect a really good advance. It's really been going up since the beginning of the year, to it, even if it's just stopping on an intermediate basis, and we go into some kind of a range-bound condition to rebuild a cause for the next move, then we would expect that reaccumulation structure to begin with a buying climax. And then from there, you go into a range-bound condition, building a cause for the next move, which we would measure with point and figure, count objectives, and so on. And so those are the things that really stand out to me here, is that if we get this kind of a crescendo of advance, as we see here from this analog, the only thing that really disturbs me about this analog, Roman, is that puts us at point 20 and the analog is over. Then what do I do with myself?
Okay, well,
like,
okay, so gold here had a downtrend. So I don't think that we're gonna have this severity. I mean, Bruce, I look at the political landscape going into 2024. Again, we've talked about this here. They're gonna try to create some kind of very, very soft landing into the election year. They just need this. And I think the Fed, as you usually say, is going to be standing, on the sidelines. And the Fed is going to be trying not to involve economics into the politics. So with that, instead of the downtrending market, I wonder if after the climactic stopping action, we would have what we've described, with the seasonality. Yeah, a much softer landing like this, right, where we're just possible reaccumulation. So we'll have to see.
Right, and we'll see at the time, but we will end a really good advance, typically with climactic events. We see that we just had on a local basis a pretty good kind of acceleration as the S&P jumped out. And we know that the NASDAQ 100 is much further along than the S&P, but we could very much have a furthering of this crescendo of climactic behavior here for the next few weeks. So entirely possible. And then we can judge what comes next, because we get a climax and then we get an automatic reaction, and that would then set the conditions for a range-bound environment and would help us to navigate what's ahead. We may not get that. We may be able to just keep marking up.
Yeah. Okay, well, let's talk about the market breadth, because we've talked about the structure, we talked about the character, we talked about the causality and potential for the effect of that. We just looked at the analog, structural analog, and it seems that, yes, we're still bullish. There is a short-term possibility of the continuation. There is an intermediate seasonality that tells us that maybe at some point we're going to stop, we're going to go into a trading range. That's going to lead to the rotation. I'm kind of summarizing, guys, for you all of the thoughts that we have had. Now let's look at the breadth, and let's see to the question of a low participation in the marketplace, Bruce. To the question for this whole year, we don't have the breadth, so I'm not investing. I'm not coming in until I see this confirmation. Could we, for sure, say that the market breadth has increased? Now it's not just 8 stocks, it's not just 15, 17% of the market that's going up, and it's a much broader participation.
That really goes to the Russell 2000 discussion that we had. All of a sudden, it had this really dramatic jump, and these stocks are, market cap wise, are small compared. They're not small companies, but they're small compared to the valuations of these really super big companies. And really, what we're talking about is the some minor flow away from those stocks towards the broader market. We should be able to see that happening in breadth indicators. This is very simply cool. These are very cool tools. This is the percent of stocks above their 50-day moving average. And we do them for 50-day, 200, and so on. But this really can show the internals and whether the internals are supporting higher or lower prices. So here we call this, at the lows, we call this a downside non-confirmation. What that means is the index makes a lower low. It might be in a range-bound testing situation, but it makes a marginally lower low. The internals make a higher low. And that shows that there is repair and improvement inside of the breadth of the market at these levels. The second thing we look for is directionality. So is the indicator trending up or trending down? And if it's trending down, you want to be respecting that directionality, because the breadth of the market is contracting, it's negative, and you often see individual stocks getting hurt, and then also you see the broader market going down. And so you can see those characteristics in these indicators. So the one on the left is the New York Stock Exchange stocks. So that would represent the companies that are typically not the big 8 or the really big cap growth companies. And they're more industrial, mainstream business kind of companies. And so you see that we, just to go to the most recent, if we look at the May period, note how the New York Composite Index on the bottom there is making lower lows, and the internals are making higher lows, which is a reflection of the breadth not breaking down with the index. And in fact, look what happened is that's a downside non-confirmation. That is a reflection of an improving internal condition, and boom, the market starts to broaden out, and you can see it rising. So now we have two things going on. We have an indicator that is moving up towards overbought, and it's in a northward direction. Directionality is important, and we see an attempt to rise upward towards an overbought condition. And that, and also note in the index, the NYA, that it's still inside of its accumulation or basing structure. And so it's got to be able to break through the resistance area, and we will be watching closely for that, because if it needs to be able to show the capacity to create demand that can get through the overhead supply that it's been beating its head against here for pretty close to a year now, about a year. Now, if you look over to the right, you see that that is a NASDAQ comp dominated by these mega cap names, and you can see the internals, which have been generally weak in the NASDAQ comp because there's like a couple thousand stocks in this index, and they've not all been performing with the mega caps that say call it the top 100 names. And now we're starting to see the breadth broadening out here since the end of the first quarter, mid-March. You can see that it's been rising, directionality has been up, and price has in the NASDAQ comp has followed that. Well, now we're getting a little bit more of a break here in the month of June, and we want to see whether or not we can have a continuation, or the thing that I would be really focused on with this indicator on the right is, do we get an attempt to rally the NASDAQ comp and even get a little higher high here from June to July, and we get a non-confirmation of the upward direction from the indicator? Does it confirm higher prices or does it not? And that would be an upside non-confirmation, and we will watch closely for that.
So something like this, Bruce. Divergence.
Exactly. Yes, yes, yes.
So lower high on the breadth, and then.
And I'm not necessarily predicting that, but I am suggesting that that was a pretty big break in June. So we could get a rally up in the comp, and that indicator may not be able to get above the high it made in mid-June.
Yeah. I actually like this idea a lot. Why? Because, I mean, look at what's behind us. This rally has been just on fire, right, in NASDAQ. The momentum is just so high. Velocity is so high. And this is a broad market, so it's broadening right here. We're seeing how many more stocks are, overcoming the 50-day moving average and staying above it.
Very important.
Yeah, absolutely. But there are spots like this. You see how the breadth just drastically goes down, and yet the structure is not broken. This is even more evident here. So the question, here is like, what is going on? Well, pretty simple. Think about how this uptrend has developed in terms of the participation of different stocks. So we said that those big 8 that actually they have around 25% right now of the weight in the indices. So as the breadth other stocks are being sold and they go below 50 moving average, those big 8, they are just supporting the market. And I think this is what's happening here as well. So some profit taken, not necessarily from the big 8. I mean, we looked at the chart of the big 8s. There is really, they are still not having any changes of behavior. And because of that, the index is not going down that much, but yet the breadth is going with more pace to the downside. So I really like this scenario that Bruce presented here for the lower high in breadth, and then for the higher high, because there could be one more push, in those big 8s into the climactic action, into the higher high, and that would produce a divergence.
Let me also
very interesting to see, Bruce.
Let me also just make one important point about this green arrow in the top chart. That's a substantial divergence from what is occurring in the index. Look at how the index goes down at the end of December. And we said at the time that the institutions are always leaning the wrong way at the wrong time. And they are in maximum pain at the December low. And they were selling stock into the end of the year to be able to show that they had less exposure to the stocks that were pulling their performance down really throughout all of 2022. And then, but look what was happening. They're throwing the baby out with the bathwater at the end of 22 there. And we said at the time here in WMD that these stocks were, being sold by the institutions. This was window dressing, and also that it was a beautiful test of the October low, which was the last prior quarter low. Notice how, look at this, look what we have in 22. We have a June low, mid-June low, end of the quarter, late September, early October low. This is all institutional. And then you have the end of the year low, which was massively non-confirmed by the stocks above their 50-day moving average. And that was a multi-month divergence in that indicator of stocks above their 50 and was a beautiful buy signal. And and now you might even argue the case, Ramon, that
Yeah, I'm
we
seeing it.
have a lower high now than we did at the February peak. And so could we have a downside or an upside non-confirmation of breadth because we were unable to get up to the higher levels? And we will watch closely and watch these internals to see whether we get any kind of a clue about that. This break that we had in mid-June, I think, is a bit of a warning and something that we should watch rather closely and see if it can keep working its way up into a more important overbought condition. This indicator can get up to like into the mid 90s. And the top of this indicator right now is 77 and a half. So it could go above the highs that it made earlier in 23 and 22.
All right. Okay, let's move on. Let's use another tool, the up and down volume and advances declines, for the NASDAQ and the NYSE. And Bruce, what is the main message here from these two charts?
Yeah, and I'll try to keep it brief, but here the top cell on the left, the top of this panel, top panel, let's call it, is just the 10-day advance decline oscillator. Overbought, oversold oscillator with divergent characteristics that can show up. And I just want to point out there that note how, a little hard to see here because this is somewhat of a small chart, but you can see here in mid-June, this indicator at the highs did not appreciably make a higher high here, and the index itself was making at least a recovery and a higher high from the April high. And so there's a bit of a non-confirmation right there. And then below that, this is just breaking out up volume and down volume on a 10-day basis. And you can see how much the down volume has expanded here in June. That's the red line. And so it's really taken off and the market is broken a little bit. Some of that could be quadruple witching expiration. And so we'll keep that in mind. And then finally, you can see that this is working towards oversold on the cell below that is the panel below that is just netting those two numbers together, the up volume and the down volume. And then the one on the right, same idea. This is the NASDAQ comp, New York on the left, on the right, NASDAQ comp 10-day basis. It's got marginally overbought, but not extremely overbought. And so we'll see whether that can happen here as we get into the new quarter. But also you can see that on a net volume basis, the bottom panel there, that you can see that the down volume is dominating, the up volume is working down towards oversold. So for now, I just see a correction taking place internally. I would expect another rally out here in the next little bit, and we'll see whether there's divergent characteristics in that rally or whether it can work its way up into a more important overbought.
I would be questioning here what kind of reaction we're going to have here. Like we're seeing this cross between up and down volume. Go to different places on this chart, trying to identify maybe the same type of sequence, like for instance, this area right here, or maybe this one right here. And we kind of could see that we could be either in a trading range or going down. What we don't want to see is very, very abrupt move of the up volume to the downside and relatively high acceleration of the down volume. But more importantly, behind all of this, you always have to look at the price action. What does it do here? This is a pretty significant decline. This is a local change of behavior. What about today? What about this last 2 weeks? Is there a significant change of behavior? No. Is there a significant reaction? No.
No.
So we have to think about the context of the structure when we look at these things, and make sure that we interpret them correctly.
Yes,
Okay.
and that's where the tape reading part really comes in, which we do here. And
Absolutely. Well, last thing about the market, and we'll go and talk about some other topics, is the sentiment. And this is the CNN Fear and Greed Index, as you guys know. And I want to point your attention that this was taken on September 29th. And Bruce, this was such an extreme fear. What, really briefly, what does happen with a general sentiment, not institutional sentiment, but general sentiment around the lows of the market where everything is so kind of like in despair?
sure, and you can see there at the end of September, end of the quarter, you see that there's a continuation down to the lows. And this is all part of that bear market trend that we had in 22. Lower low from the June low, the last important quarterly low. And you can see how they just sell the market off right into the quarter end. So extreme fear showed up, and that extreme fear was the product of the market just making lower highs and lower lows, and the Fed massively raising interest rates. Everybody understood why the market was going down. It was a don't fight the Fed, tight money environment, and the stocks were getting pummeled. So sentiment is so important, because once you get that coalescence of extreme optimism or pessimism, that can be really important for driving the market. Because what is the thing that you get when you have extreme fear and low prices like that? You have investors that have raised cash, or they're starting to sell stock, and the really smart composite operator types are taking that stock off their hands at bargain prices. And that is what that sentiment tells us. And
Now,
mhm,
for going forward with this, from this sentiment at this low, we come into this picture. So today's reading, and because of the reaction, we were at 77 today. But on June 14th, and when we had the session, it was at 81, extreme greed. So we came from extreme fear to the extreme greed by the general market participants. And by general market participants, I don't just mean the public, I mean institutions and public. But we usually would be thinking that at the point of the lowest extreme, those market participants are going to be mostly in cash. And as the market goes up, their participation will start to increase gradually, but they still will be late to the party, right? So a lot of participation increased right here on this rally. So Bruce, when we look at this rally, 81 at that point, at this high before the reaction that we are in right now. So this is the structure. How would you describe this extreme now? Completely opposite to what you just been talking, at 14.
sure. Isn't that amazing? Because here we are, you can see the September, October low on that chart back there. You can see on the S&P that there, look at that low. That was a 14 reading at that level. And then that sets up the conditions for a very, very important rally from September all the way to where we are now. And so we have a reading, but look what we get. We get climactic acceleration and a reading into an 81, and it could go higher than 81, but that's, as you can see from the top chart, that's a line chart of the history of the fear and greed since middle of last year, and you can see that's the highest reading. Now this is totally a timing tool, Ramon, because I have to sit there, and because this number changes intraday. And
Yes.
I'm like, I'm trying to top tick this number so I can capture it for us to look at.
Hold on a second. Are you saying that other people are looking actually at the charts? You, for the whole session, just looking at the
Yes, I'm just
CNN
looking at the
day
fear and greed.
numbers
I'm going,
on the
and
intraday?
I have to admit, I missed it because it went to 82.
Oh my goodness. All right.
Anyway, so it's kind of comical, but but look at the acceleration of prices up, and it also coincides with the economy appearing to get a little better, and the Fed now in a position where they were pausing their rate hike cycle. And so now all of a sudden there's all these background conditions that are encouraging people to have optimism.
Mm-hmm.
And so here you can see that.
Bruce, you mentioned the Fed and the rate hikes. Just one thought here, just going to throw it out there. And we might have touched upon that a little bit last time, but I was talking to WTC 2 students yesterday about this. Powell was talking this week, and he said that we still going to have probably 2 more rate hikes.
Mm-hmm.
And my argument here is that it doesn't really matter whether they're going to go with 2 rate hikes or with none, or maybe with 10 of those after this moment. People who cannot buy the products because of the high interest rate right now, they will not be able to do this after 2 rate hikes or 10 rate hikes. So from that point of view, the rate hikes or the number of them or where we finally end up really doesn't matter. Who cannot afford to borrow right now, they will not borrow, and therefore they will not buy and they will not spend the money. But what's really important with the Fed currently is the duration of the restrictive period. And this is what, Bruce, I'm looking at and kind of like trying to see where they're gonna start actually changing their policies and actually going into more of not just the pause, but actual easing. I mean, this is probably the most fascinating chart that we go through periodically. And we've talked about all of these areas where, that I highlighted in red. And we're seeing that before a major decline, before a major recession, we always have the situation where the Fed rate is above the 2-year yield. And then we see the area where Fed pauses after the tightening. And currently, we are kind of there. We still, if we would have 2 rate hikes, okay, maybe a little bit more. But then look at this, the 2-year is already below the Fed rate. So
Well,
we have all of the steps, Bruce, that are there. And the only thing that I'm looking for is some kind of break, the break of this. Give me
yes,
some kind of break of the 2-year yield structure. And this is the timing for a possible reaction, which is
yeah.
more meaningful, which is not bullish reaction, but more of like more of the bearish reaction. And then this becomes a big question of how would we go? Could we go to the all-time high? And then if this is to happen, then what are we going to see here? We're probably going to see something like this, and then we will be talking about a much larger trading range. What's your view on this?
One footnote, the Fed funds rate and the 2-year the scales are slightly different, and working on trying to get them on the same scale, but that's not what's important about this chart. So the thing that's important is in Gunlatch, Mr. Gunlatch is the one that really points us out. Get rid of the Fed, just follow the 2-year. And that's his message. It's like, you don't need the Fed, just let the 2-year sets policy. So you can see the rate. So the rate goes sideways. Well, look what happens. Like if you look at 2006-07, you see there for a year that the 2-year rate went sideways. Well, the Fed stopped raising at the same time. And so the Fed just waited, and then all of a sudden the 2-year broke and the Fed followed it down. And so you see this happen over and over and over. And so now the Fed is actually threatening to raise again 1 or 2 times this year, and they have paused. And so this data doesn't get updated, on a daily or even a week. It gets updated when the Fed makes a policy change, so that we don't have that yet in the chart. But the point is that the 2 years going sideways, and the Fed has all of a sudden stopped raising, and they're taking a wait and see attitude. Now they're threatening to raise again because inflation continues to be persistent inside the core and all that, but has come down. So what we really want to see is, and Ramon made this point like a week or two ago, and it was such a good one, is that as long as the rate goes sideways, as it has in the past, the stock market typically keeps going up. And so we see that there is the potential when the rates are going sideways for the stock market to keep rising. It's when rates start to fall. And when rates start to really fall, and they haven't done that, is when the rates are starting to signal a slowdown in the economy. Now that may happen.
I really like this whole concept, Bruce, of the 2-year. When it starts breaking, when there is this relationship between the Fed and the yield. And yes, it's a very important point here that the market can still go up. Well, in our case, what's the immediate target right here? NASDAQ will outperform, it could go above this, but something like Russell, the Dow, I mean, like they're gonna have different structures, and hopefully S&P is gonna get there as well.
Yeah, so there very well could be that we see these indexes to their old 2021 highs, maybe even a couple of them get above those highs, and interest rates are just going sideways roughly in this area in the meantime.
All right, let's talk in the same kind of discussion about the 10-year yield. So this is probably the most fascinating chart to me right now. I mean, the vertical chart. I'm going to talk about this in a second, how I'm reading this, but what about the PNF, Bruce? What does this suggest to us?
Well, this is the way that people accuse me of being a Fed watcher, but I'm not. I'm a point and figure guy and a Wyckoff guy. And so here you see this is yields, the point figure on the right. And that's yields, and there is point figure structure there. And so the scale, just to explain it, I'm sure you all figured it out, but the scale is like 38 is 3.8% is the yield on the 10-year. 40 is 4.0%. And so just so you see that. And then so here's a reaccumulation structure, 14 columns here in late 22, and it came out of that area and went up and counted up to 4.2%, 4% up to 4.2. Now you can see a swing trading count that has marginally jumped out of the swing trading structure. You can see that I've counted it. It's in blue, and it's jumped out, and now it's pausing here around 3.7%. So it's a jump and a backup. This count could be made bigger. I know some of you are saying, well, maybe the count should be bigger than this. Maybe it should, but I see this little 11 column count being a really classic swing count, counts up to 4.4, 4.5. And Ramon, what I would say here is that today Powell gave a speech to all the other central bankers. They had some big confab somewhere. And he said, brace yourselves, because we could raise maybe 2 more times here in the months ahead. And so there might be the 2 rate hikes right there is signaled in the actual trading of the 10-year yields, and the fact that they literally, if they went from here up to 4.4, 4.5, that would be about 2 more rate hikes. 1 to 2 more rate hikes.
Yeah, it's kind of like an interesting scenario where I'd say the Fed is creating the structure for the yields here, and specifically for the 10-year right here, because when we started seeing this, and then this bar has happened, our statement at the end of the day on that particular bar was that we are in the TP distributional formation. So don't worry about why it's called a TP. It doesn't really matter. Concentrate on the bias, distributional formation. And we kind of stated that from now on, we're going to see the slowing of the momentum, and then we're going to come try to rally into the selling zone of this breakdown bar. And it happened exactly that way. We defined the strength of the downtrend. We said that we had this second significant breakdown bar, and also the second selling zone was related to this breakdown bar. So we are fractally repeating what we have done before. So my expectation, as you guys know, was that around this area right here, after the lower high, we have to break down, and we have to have the third breakdown bar like this. And that would complete the construct of the distribution. Yet, the Fed obviously had other ideas, and we listened to the Fed. We don't fight with the Fed, but we also look at the tape. So what do we see? This day right here and this day right here were the days when there were a lot of messages from the Fed about their hawkish outlook for 2 more rate hikes. And I think these are the attempts to discount this news. I mean, the fact that they might actually raise more is already discounted. It should be discounted in the price because that's how the market works. The market does not necessarily discount at the event if they know that the event is going to be done this way, and the Fed is saying we're going to raise the rates again. It happens at least at the time when it's announced, and those were attempts. And I don't see any breaks to the upside. And of course, this contraction is going to lead to the expansion, and we either going to have a very quick move up or very quick move down. My argument again about the yields is that it doesn't really matter how much they raise. I mean, they could stay here in this restrictive environment, and that would be sufficient. And who knows, maybe they will not raise, or maybe they will raise only once, or maybe they will raise twice. And this is not going to influence the yield at all. So to me, this is kind of like the most fascinating chart right now, Bruce, because behind all of these attempts to go up, what do we see? Immediate negation on the next 2 bars, attempts to rally, and all of them are failing with the lower highs. There is nothing there for the demand. Now, selling also has diminished. So here's another possibility, Bruce. I was discussing this with William today in the tape reading class. We've come here, and it looks like, there is some strength. There is some bullish strength right there. What if we are in phase B of a smaller structure? And what if we just retest the low here with some kind of spring event? And that's why we're seeing some weakness here, lower lows, lower highs. And then after that, we go into the upthrust. Could be a local upthrust right here on the rise of those interest rates. And then after that, still going down. So global structure is still of the distribution. And then local structure could be just a temporary short-term weakness going into strength, into short-term strength.
The 10-year since October has been saying that yields aren't going up anymore at the 10-year level.
Mm-hmm.
Yields aren't going up, they're going sideways. And the Fed kept raising, and just at their last meeting took a pause. So I think that's fascinating because the 10-year is discounting something different from what the Fed is doing. Mm-hmm. It's not participating. Now, I think that upthrust idea makes a lot of sense. And also the point and figure kind of argues that you could actually upthrust that 4.3 yield level, mm-hmm, and then have a more important reaction.
But one way or another, I mean, this scenario of the upthrust action, mm-hmm, or this scenario of the local upthrust, or mm-hmm, almost immediate capitulation here, still has one major point. This is a distribution. This is not necessarily an accumulation.
Good point.
Okay, let's go somewhere else. By the way, speaking about all of those big cycles in rotation, currently we are having this special on the business cycle that is conducted by Joe Turner and Bruce Fraser. And what a great start they had last Thursday. So this week, tomorrow, we're going to have the second class. I've watched the recording, and I thought that was such a good foundation, Bruce, for what's going to come next, where you and Joe are going to discuss more and more of the practicality and the technical element of the business cycle rotation. So how was the first session for you?
Oh, it was fantastic. Joe is just, the business cycles in his DNA. I mean, he's amazing in terms of his feel for it, and he just lives it. And because of that, he has a perspective about it that's truly unique. So we're talking about how all of these cycles relate to each other, and we just buttoned up slides for tomorrow. And people can attend live for tomorrow and watch the first one as a recording on demand. But we're going to literally disassemble the classic business cycle. We're going to go through and we're going to talk about the characteristics of the stages, how the different asset classes perform in all the different stages, and then we're going to talk about asset allocation. What is the typical performance of each of the sectors in the different stages? It's going to be, tomorrow's going to be really, really good, because we're really going to really dig deeper. And so this is really fun.
All right, so still a chance to sign up, watch it on demand, watch it live, whatever you prefer. Also, going to remind everybody who are guests today, WMD promotion that we're having today to next session, $79 per month. So you could go ahead and register. Okay, let's jump to something else. So on our website, you could find under the watch list right here on the top, a communal Wyckoff watch list. This is a weekly watch list that we are creating with our students, and we curate that list each week. You could look through the list on the website as well, or you could download it and put it into any of the software that you use for your watch list. I like to do this in a slightly different way, Bruce. On the daily basis, I receive an email with the collection of all of the names on the Communal Wyckoff watch list, and they are sorted in terms of their performance. So for instance, today, this Jovial Aviation was the best stock. But what I really like to do when I receive this list is, first of all, to see how many stocks do we have in the positive, and especially above like 2%. And this is a really good breadth for today for this particular list. And then after that, I want to see what kind of stocks we have here. What is moving? I'm seeing like, okay, Shake Shack, we have some software, quite a lot of software, and usually I want to kind of gauge as to thematically where institutions are putting the money in today. We see a lot of pharmaceuticals, biotech, and so on and so forth. So a lot of stuff that is moving. You could really see right away what are the themes that are of interest to institutions. I would suggest for our selection purposes, and we are at 4:15 right now, so we have 15 minutes left. Let's go to some of them. I want to look at Squarespace.
So let me ask you, Ramon,
Yep.
Anybody can access this list, right?
Yes, so thank you for asking this. Anybody could sign up for the Communal Wyckoff watch list. It's free.
You sign up at stock charts?
It's through the stock charts. We love stock charts. They're
You can get the list and then you can put it in your own charting
Absolutely.
platform. You
Yeah.
don't have to use
It
theirs.
doesn't have to be a stock chart. You could just download the list in Excel spreadsheet and upload it, to whatever software you use. Okay, so
Okay.
let's look at some of them. So here is a Squarespace, obviously software. Bruce, what do you see here?
A large accumulation type structure goes back to March a year ago, and beautiful climactic decline in May of last year, and then a very sharp advance, selling climax, automatic rally, range bound condition. Notice how the market became very range bound from May of 22 all the way into late February, early March, and then it broke out, and now it's pulling back, testing from above, old resistance, new support, and the initial decline there in early May says we've had some kind of a local selling climax in possibly a reaccumulation structure. So I would be looking at this as reaccumulation. Now we've had our second test of that lower area with this recent decline. I'll be very curious if this Squarespace can get back up to resistance, maybe even go through that area. I think it's got more work to do in here, but it looks like reaccumulation.
All right, let's go to something else. Let's do a couple. Let's go to that Shake Shack. I really like the structure here for the longest time, and Bruce, I believe that we've discussed this at some point. So we're looking at the accumulation range right here with the sell-in stopping action with the preliminary support. It's slightly upsloping structure. Where we've seen a lot of the time the price has spent in phase B in the upper part of the trading range. So this is one of the characteristics, phase B for stronger stocks. We're seeing a very typical decline after the local upthrust in phase B, 1, 2, and 3 into phase C. Last point of support, just because this is a higher low. The sign of strength has all of the demand characteristics that we need, all of the momentum increase characteristics that we want, and look at the flatness of this backing up action. It's so flat, it's so non-volatile. Whatever supply is coming in, it goes away by the end of the structure, its own trading range with its own phase C, and even more dynamic rise out of that structure. And then again, a sign of strength, a backup, and now continuation. So currently in the uptrending action, and starting to outperform right here. We're seeing this in the relative strength that there was, it's been outperforming since actually last July. Bruce, one more for you, and then we'll go somewhere else. Please pick one.
Okay. Just pick one, Ramon. I'm okay.
Okay, let's look at something else. How about let's look at
Palantir. Let's look at Palantir.
I'm sorry?
Palantir, right above it.
Okay, yes. All right, so this is in the news. Bruce,
Yeah.
what do you see here?
So look at that big gap down with a climactic surge, and then it starts to march upward. And the initial rally up to the early June high sets the resistance area, but then there's an upthrusting action into August, and then has a very long grinding decline into December, end of December. Note the difference between the decline that occurs from August to December versus what occurs before that, which is much steeper, much greater dramatic acceleration. And so then you have a February upthrusting action of the resistance, and then a last point of support. And that last point of support there, which takes quite a bit of time to unfold and actually lulls traders into looking somewhere else for something to do, has a initial gap up. I think that was on earnings, right? Look at the beautiful volume contraction. And if you had traded this at the resistance area that was formed by the early June 22 high and traded it there, you would have had a terrific trade at a minor backup up into the run to $17. And looks to me now like this was all absorption, all accumulation. And so I'd be looking for reaccumulation to form and potentially higher prices.
And what is the causality here, Bruce? Because a lot of the times what I hear from students and traders is that, well, we're at $15 and it was at $6. How could I go in? It just advanced so much. Is it truly about the price? And I'm being truly dramatic here. Is it truly about the price, or is it about the structure?
This is such a good point, because Wyckoff is very contextual. You'll see here that Roman laid out phase analysis. So he's saying, okay, we have phase C, phase D, and so on. When you start to go from a range-bound situation and accumulation where stock is systematically being accumulated by this composite operator, they're going to buy shares in the value zone as long as they can without putting the stock up on themselves. But eventually they end up wrapping up almost all of the stock supply, making it very hard to buy. When that happens, you get these massive changes in character in the way the stock trades. It starts to go up. Look what happens after phase C. That rally up to the resistance area is a massive clue that stock is now in strong hands. Look at how that rally contrasts with the rally from the May 22 low up to resistance, much more labored on the way up. That's classic early accumulation events. Then when the stock is really strongly held, the May low of 23 sets off an absolute launch. That's when a Wyckoffian is going to get busy, get to work, and want to own that stock, because they know that they're in there with the really strong hands of the composite operator. They want to own, they want to buy, and they want to own it in conjunction with these strong hands, and only when the stock has been fully absorbed and very difficult to buy by institutions. And so look how high the stock got to $17. Look how high it is compared to the resistance level, which is at around $10. That's a very bullish sign. So I'll leave it at that for now, but that would be the way I answer that.
Just one more point. This is very significant because on average, it increased by almost a factor of what, 3 on average, not at the spikes even more. This shows increased market participation and urgency to buy by institutions. This is a leader that is now and also in the foreseeable future. So I'm just going to leave you with that.
As a Wyckoffian, you'll learn to read how the character of the stock changes when it's either under extreme distribution or extreme accumulation and difficult to buy, or it's being distributed by the CO, and how the stock conducts itself accordingly. And really, nobody does that better than Roman. Roman does a good job of demonstrating.
Well, Bruce, thank you so much, but we do it together. All right, so 424, Bruce, let's jump to something else. We want to show everyone some other things that we have. I mean, come to our website, check it out, wyckoffanalytics.com. We have a lot of free stuff, the Communal Wyckoff Watchlist. We have the bias game, weekly bias game that is done at such a high professional level. We are teaching you stuff we're teaching you the Wyckoff methodology through the bias game, and it's free. It's free on the website. It's free on our Twitter at Wyckoff Analysis, and we also discuss this in our classes. So check it out. But we also have other very interesting things. For instance, there is a lot of intraday work that we're doing with William. There is a lot of process-oriented work that we do with Franz. And with John, John treats us to the Wyckoff structural scanning. This is a very novel idea to base the scanning on actual Wyckoff principles of how the structure unfolds using still modern technical analysis indicators. And with that, John, please take it away. And what are we going to discuss today?
Well, today we have a look at price bouncing off a rising EMA and where that fits into the Wyckoff structural analysis. So great to be here this evening. Welcome to everybody. This is the SPY, just conventional ETF, and we see that it's bouncing off the middle of the Bollinger Band, which is a 20-period moving average. So we have activity coming off a moving average. Can we scan for that, and where does that position us within a Wyckoff structure? So if we look at the scan language that we have, very, very simple. We're looking within a variety of indices that gives us professional curated selection for the target of the scan. And here, very simple, rate of change over 3 periods is greater than a 10-period rate of change, some level of acceleration recently. The next line is that our rate of change on a EMA 12 over 10 periods is greater than 0. So that is our rising moving average that we're focusing on, is our 12-period EMA. And we'd like the EMA 12 to be greater than its 26-period counterpart. And folks at home might recognize 12 and 26 EMAs as the cornerstone of the MACD. So this is related to the MACD. We're also going to put in a volume filter so that we get a little bit of a bulge of volume in recent days versus a 10-period average of volume. And the current 3-period average of volume has to be 125% of the 10-period volume. So nice ramp up in volume, rising moving average, and more recent rate of change is higher than a 10-period rate of change. We're going to sort all that by the 3-period rate of change. So if we look at what happens when we run that scan in 1,000 stock population, 27 stocks satisfy that criteria. And dispersed in real estate, tech, communication services, discretionary. So it's fairly well distributed in terms of what is meeting that criteria. If we look at our first chart, it's Vornado, the real estate trust, and we see a very interesting stopping action in mid-March, horizontal action with a breakout, slight retracement, but you can see the blue line is the 12-period EMA, and you can see where price went down, tested that EMA, and shot right back up with a bulge of volume associated with that price action. So it does appear to meet our criteria and positions us perhaps in a phase C or D of a Wyckoff structure. So using the concepts of how structures unfold, we can actually pinpoint with moving averages, rates of change, even conventional indicators, we can pinpoint where those stocks are. So our next is Amcor Tech. This is semiconductor, completely different animal, but very, very nice move up and off the blue line, the 12-period EMA. And this is much later and possibly a larger structure going back to even November. So we see up in May, rising moving average, down to test, big bulge of price movement and volume associated with that move. So puts us in the running for a breakout of a substructure, rising up to the 31 area, which has been resistance for quite some period of time. Our next stock is from the REIT area, also Boston Properties. Again, very, very much of a family resemblance to Vornado, down, bottoming in March, horizontal movement, test of the 12 period and up, and slight retracement today. Notice the recent bulge of volume associated with that rising price action. So very interesting things happening in the REIT world. Our next is Charter Communication. That's communication services, entertainment, large structure here, and we're moving up off a higher low, so an LPS. Nice change of character in recent days, down, tested, even really went below the 12 and came right back up with a nice bulge of volume. So here we have a nice structure within a larger structure that could give us momentum up maybe to prior resistance around the 415 level. So interesting one to keep an eye on there. Next is Mattel, the toy company, consumer discretionary. And here we have an upsloping structure. Price has tested repeatedly a rising 12 period, but that's been flopping around a little bit. So bit weak, bit more weakness here. Now, one of the things in the way we sort is as we go down the list, lower rates of change closer to the event. So in this particular case, we are closer to that bounce off the 12 period, and it is rising, not super rising, but it does meet the criteria. So that's what we have for tonight on the scans. And this is something that's accessible in another product, the Wyckoff Market Report. We have that published weekly, comes out on Fridays. A lot of market analysis, and it actually analyzes market action in terms of the nature and quantity of Wyckoff events occurring that week. Very unique perspective on the market, and we do chart each type of element that's depicted here: springs, backups, upthrusts, breakdowns, and that is charted every week, so you can see where are the Wyckoff events happening. So that's what we have for tonight.
Really great. First of all, John, I really love the scan because it's appropriate, it's timely for the current market. So we want to catch that initial decline, increase of the demand, and then the push up in price, obviously with the background of the accumulation. But here under the hood, this is something that I wanted to do with you for a while. So I had a question when I looked at market reports, like I usually go to this page, and I want to ask you this question. I'm seeing that the sprints and last point of supports are going down. Now, to me, I interpret this as a possibility that we are actually having a smaller number of sprints just because we're moving up. Is that the case for you as well? Is that your thinking as well?
Absolutely. So if you look at springs are interaction with support. Here we see minimizing action at support, but if you look at upthrusts and backups, those are both interactions with resistance, depending on how they resolve. The upthrust resolves below resistance, the backup typically above resistance. And we see the both of those have gone up over the past few sessions. Backups are down, but upthrusts are quite a ways up. So here we have breakdowns. Again, very small number of breakdowns. So another aspect of interacting with support shows fewer events are occurring at support versus at resistance. So it is very important in developing our understanding.
John, as usual, I want to go further than this, and you know where I'm going with this. Could you correspond the chart of the market with with these charts right here. And let's just look, and maybe we'll see something there that is going to be like an aha moment for us. So let's do this together, if you don't mind.
Well, we are working on that, and we're beginning to assemble enough data and enough market variation that we can have some meaningful reflection on that. So that we are working on. We do have the user-defined indexes set up and need a little bit more data point to add to it. But I think it's going to be extremely interesting. And I view it as proof of concept. It really demonstrates the validity of the Wyckoff method. It's incredible.
All right, Bruce, questions, comments?
Just to make the point that it was commonly considered that you could not scan for Wyckoff setups. And John has been diligently working at this for a number of years now and has really proven that in fact you can scan for these different types of setup conditions in the charts. And the newsletter actually has links to all the stocks that meet the criteria. So you can go into the newsletter. You only want to look at backups in an uptrend. You can go in and you can click through and look at the individual charts on each one of the stocks that qualifies in the scanning engine as a backup. And it's so it's such a powerful tool for being able to leverage your time. And so this is what we love about this tool. And then also you have links here that you can go into for industry groups, sectors, and indexes. But this really has, like I think, broken new ground on how to scan for Wyckoff. Leave it at that.
All right. One member of our audience today is asking, now can you create the scan using AI and it works? Well, yeah, of course. But John, I would argue with that statement because, I mean, first of all, you need to identify the assignment for the AI. And how do you define that assignment? You have to know the context, and in our case, Wyckoff context. So it's like you have to be a specialist in the Wyckoff methodology to understand the context of the scan that you're creating, because AI is not going to just pick up and just say like, oh, just give me that scan. So I think what's valuable is that understanding that you could scan. And by the way, you don't have to use the AI, you know, it's like, go to John, ask the question, ask him to create a scan. If anything, why, you know, you're identifying yourself like that. Come to the Best of Wyckoff. John is gonna have this session where in front of your eyes, you could ask for any scan that for John to create, and he's gonna produce it in front of you. So that's the session that we plan on there. So we'll definitely looking forward to this, John, to this session, and we can definitely talk. This is a good question, though, for our Q&A panel. I'm going to ask you at the Q&A panel, what do you think about AI creating the scans? So,
well, and I think John has WI, which is Wyckoff Intelligence.
Oh yeah, so, Eric C is saying John is our Wyckoff AI awesome individual.
WI, yeah.
WI, okay. Well, John, thank you so much. Bruce, I want to have maybe like 5 more minutes of your time because we still have people on. So I want to discuss just one thing that is of interest, and that is Bitcoin. So could we just quickly go through the analysis of the Bitcoin? Of
course,
so,
yeah.
Okay, so with that, what do you think about the structure? What do you think about this uptrend? Because there are a lot of thoughts from people that this is kind of like an unaccomplished upthrust, and that it's going to lead to the change of behavior, and we're going to go back to this, you know, 18, 20,000, which I personally don't see. I don't see any changes in the structure. I don't see any changes in the character. If anything, the current rally is actually confirming the bullish environment. But Bruce, what are your thoughts on the last rally?
Well, again, let me put it in context. This looks like accumulation. You can see there's sort of a last point of support in March, selling climax in June a year ago, automatic rally, then another selling type event, secondary test, or maybe that's a climax in November. But note how orderly that all is with very well-defined resistance. Jumps up and out in March. Remember how we were talking about once you have completed accumulation, you change the way the market behaves, and look at how it just marched straight up. Big, huge bars of price with expanding volume, and then it goes into this long, protracted backup, it looks to me like. And so that backup, the early part of it has the most volatility. Each subsequent decline from the April reaction and early April, late April, and so on, each one of them diminishes in its volatility as it backs up towards the old resistance, which is now support, and also it is the bottom of a trend channel. And then it reverses off of that with really good volume, which is exactly what you'd expect to see if you have completed accumulation. Is you'd expect it to back up, become dull and quiet, diminishing volume, and then when it starts to reassert itself in the direction of the primary trend, you start to get volatility in the upward direction and volume expansion. So that's what I see there, Roman. And so the next thing I would look for here is if in fact we have that as the case, it should be pretty dull and quiet at this level, which is resistance, the early April high. It should be able to be dull and quiet there and then just be able to continue and take out these highs and keep going.
I'm gonna concur with your assumption here that it's going to continue to the upside. I mean, yeah, we could definitely go down, but what is the higher probability? Like probabilities will always work in the way how events unfold. A lower probability also could work out, but the higher probability is what just Bruce has said. So to concur that, look at the expansion of the result, look at the expansion of the effort. Bullish, yes, for sure, this is healthy. Okay, but then the biggest argument, but we are at the resistance. We are in the upthrust situation, yes, but we've been there before. First leg up, test, continuation, further up. First leg up, test, continuation up. First leg up, one, test, continuation up. And I could go on and on. There are a lot of bullet points here, like for instance, the volume signature compared to the previous rally, the volume signature compared to the global demand on the impulse wave. Then also look at the verticality of the reactions. What do you see? Vertically down, straight down, shakeout. Look at how verticality changes. What do you expect next? Come to the overbought condition, overcome the long-term downtrending line, suggesting what? What is the deduction here? Long-term bullish. But because we're in the overbought condition like we've been in the previous times, short-term bearish. And that's the confusion usually that people have. How do they reconcile two different time frames that are showing different biases? Well, that's the whole thing. You have the one time frame and another that are completely different time frames. So imagine this, extension and then shortening of the thrust, number one, shortening of the thrust, number two, preconditions for the potential decline or going into a trading range. It's very logical that we're going to have the trading range around the downsloping resistance line. So Bruce, I would be expecting something like akin to like something like this, where we have this change of behavior, probably with this support going to play out at that point. And then I think we just consolidate for some time around this resistance, absorbing all of the gains that we have made since the November of last year. And more importantly, again, verticality changes, and that's important. This is what we have seen in the S&P 500. If we're going to see this, this is most definitely going to be a breakout and continuation like the one that we have just experienced in the S&P. Look at the verticality of the selling climax, of the spring, and then what happens? The distance and verticality changes and hugging resistance, exactly where Bitcoin is going. So that hug of the resistance, thank you, David Weiss, for that term. And what is the resolution? Not only directional resolution to the upside as the bias, but we stated that from this, because this is an area of absorption where supply was dominating the demand, but with no downward result, we are increasing the momentum after that because this was the last absorption in this whole structure. And with that, Bruce, I think we're done for today.
Nicely done. That was really good.
All right. Well, thank you guys so much for being here. Don't forget, for those of you who are guests, we're having the promotion this week. Sign up. These are kind of like today, we didn't do anything extra, Bruce. I mean, like our idea was just, let's just kind of like, do the regular session. But thank you so much for all of the comments that we're seeing here. A lot of you enjoyed this, so come next week. Bruce, thank you so much.
Beautiful.
That was great. John, thank you for your scan. It was very helpful, and we'll see you all next week.
Thank you all for being here. Have a good week.
Bye-bye.